All right, guys. So my name is Brandon.
And I'm Drew, and together we are Brand Drew Real Estate. We have been in the business for about 8 years and have worked with Dan for most of that. He's actually worked on a lot of our personal deals, and he's actually helped a lot of our clients who also said that he's very educational, communicative, and responsive with his responses so that they know what they're getting into and they understand the whole mortgage process from start to finish.
Yes, and so like I said, we've been in the business about 8 years, and for the most portion of that, we have worked with Dan as strictly our main lender. Dan does have two awesome boys. They keep him on his toes, and he's an amazing father. On top of that, he's an amazing mortgage lender. Not only has he helped our clients with what he's about to tell you about today, he's helped us. We've bought multiple homes using house hacking, and without going too deep into it, one of the main things is buying houses that have mother-in-law apartments that you're able to use as an ADU because you can use that as extra income. He'll get deeper in that, but we've done multiple of those with him, and we've done tons and tons of difficult deals with him, and so we highly, highly recommend him. And so we're here to support and host him today. He's awesome. I hope you guys enjoy everything he has to share with you today. So that being said, Dan,
all right. Okay. Yeah. Thanks, Brandon. Thanks, Drew.
You're welcome.
Yeah, they're great realtors. They're who I use on my personal deals as well. So we work a lot together, which just kind of creates a good synergy when the whole team is all on the same page together. So first, we're going to talk about why should I buy a home. So if you're on this webinar, you probably are a little bit convinced already that it's something that maybe you should do. This class is mostly geared for first-time home buyers, but it also is for people that already own a home and are looking like, how do I expand from that onto the next step and kind of get multiple properties and rentals as well. So whether you are right at the beginner, the very beginning, or if you have a little bit of experience already, you'll still learn a lot of cool stuff in this class. So first, why buy a home? Tax benefits. On your primary residence, your first home you buy that you're living in, you get a mortgage interest statement from your lender at the end of the year. It does depend on how you file your taxes, whether you're doing the standard deduction or itemized. But if you're doing itemized deductions, you can deduct the interest you're paying to the bank and then also the property taxes. Predictability. So, anybody that's rented or is renting now knows about this. Rent only goes one direction. It only goes up. Every few years they creep a little bit at a time, not to, hopefully get you to leave, but it's like boiling the frog in the water. They're just turning up the heat slowly so you don't jump out of the pot. So when you buy a house, you get, your interest rate fixed for 30 years is the standard. There's other options, but not, 95% of people just do the 30-year fixed. So what that's going to be for, basically all your working years, hopefully. Property taxes and insurance do go up, but it is, pretty predictable. It kind of just moves along with kind of the rate of inflation. So it's still, a steady increase over time. You get the appreciation. So anybody who's not living under a rock has seen what home values have done the last 5 years ever since COVID. So yes, there are ups, sometimes downs in the short term, but over, decades, it's going to go up. So you can grow that equity. I see all the time, a lot of times when, older people retire, a lot of times their whole nest egg is in their house, and that ends up being like their legacy and inheritance to their children, even if they don't, have a bunch of money saved up in a fancy, retirement or investment accounts. That house is, when you end up downsizing or cashing that out, it's going to be, basically your legacy. So, and then, there's the freedom. You get to do, anything you want to the house, however you want it, without having to ask permission from anybody else. And then the stability. Once you have kids and a family, you don't want to be, moving them around every couple of years because your landlord, decides to sell your rental, or you need, to find cheaper rent somewhere else. So, just being in one place, one school while your kids are growing up you can't put a price on that. So this slide is just my little joke about, landlords just painting over everything. So they've even painted over the tenant there in the bottom right. Han Solo from Star Wars, but okay, so here's a little bit more about what we're going to cover today. So first is the home buying basics. So not the most sexy or interesting topic, but it is where we got to start. So we'll teach you basically how to get pre-approved for the mortgage. So what kind of credit score you need, what kind of down payment you're going to need, and then DTI is a term we use, but it's your debt to income ratio. So basically, what are you making at your job each month versus what are your bills on credit? So we'll cover all that. That's the foundation that everything else is kind of going to be built on. Next, we'll talk about house hacking. That's the fun stuff. We'll teach you how to buy a primary residence, get other people to help you pay for it. And also, in recent years, the mortgage companies like Fannie Mae, Freddie Mac, the ones that FHA, the ones that are providing the loan programs, have actually allowed you to use rental income on your primary residence to help you get approved for the mortgage. So that's very helpful where, we are in a more expensive, cost of ownership environment right now. So that gives more people access to even be able to buy a house in the first place. And then also being able to afford your payment once you're in the house so that you're not house broke. Next, we'll talk about where do you go from there. Once you have one house, getting the second and third without having a big down payment. So this class is designed for the average American that's just, working a normal job every day to pay their bills, paycheck to paycheck type thing, and still being able, with only that, be able to build a rental portfolio to where you can have residual income each month, and then, a retirement plan in place for when you retire. So you don't have to rely on your employer or Social Security to hopefully be there, in 20, 30 years. So last, down payment assistance, we'll be talking about. This is geared towards Utah specifically, but it is similar in other states. But we'll talk about what options there are to get you into a house for zero down on the mortgage program itself. And then there's also local city, county, and outside grants that you can add on top of even a down payment assistance program, or you can use them like a la carte, however is needed. So even if you do have your own down payment, you can still get a grant to help you out anyways. All right, first, credit score. Everyone deals with this, whether they're buying a house or not. But I would say credit is a little more lenient than a lot of people think for buying a house. So you don't need a super great credit to be able to buy a house. This chart's a little misleading. I mean, below 680 is totally fine. It's not bad at all. There should be, more brackets below there, but kind of the industry standard is 620. You want to be 620 or higher, ideally, to have a smooth, easy process. But with an FHA loan or a VA loan, which are veterans loans, we can do starting at around 520. Some of them say no, like they'll say there's no minimum credit score, but like actually getting through the process below, 580 is going to be an uphill battle no matter what. But so down payment options, USDA, that's rural housing, but there's a lot of rural areas you wouldn't expect. So like all of Tooele, anything north of Ogden, so Brigham City, Tremonton, Logan, outside of downtown Logan, most of the surrounding areas, all rural housing. So there's a lot of places you can use that one. And they just finance 100%. You don't need a grant. You don't need to borrow any money. They just finance the whole thing. Same with the VA loan, 0 down. That's for veterans. If you have the VA benefit, you're golden. That's like the gold standard, best loan program out there. Easiest to get done, best rates, best terms. So it really is a true benefit for the veterans, which is great because they deserve it. Next, you have conventional. That's where people get confused on the down payments, because a conventional loan, as you see, actually has the next lowest entry point. So as long as you're a first-time home buyer, which they only look back 3 years. So if you owned in the past and had to sell it, after 3 years on any loan program, they consider you a first-time buyer again. So yeah, if you have really good credit, that's kind of the go-to choice. Sellers love it. Everyone loves to see a conventional offer on the house because it basically implies, it's an assumption still, but that you have, really good credit, good income, you're on top of your stuff. So FHA, this is a really popular option for first-time buyers. You don't need as good credit. So conventional, you want to be at least 680, 700 plus is ideal. FHA, that's where you can see here in the details, you can be 580 and up and do 3.5% down. If you're under 580, you can still do it, but then they want 10% down payment. But again, the score itself, I mean, if you're under 580, it's gonna be tough. So just having like the score they want doesn't get you the loan. They look at everything on the credit report to see why the score is that low. And then 5% conventional, that's once you already own a house. Once you're buying the second and the third, as long as you're moving into the new house and keeping the old house, then you can continue to do that for 5% down. So we're going to have a whole section on that because that's kind of the key part of this whole thing. So, and then, if you do put down 20% on the conventional, you don't have PMI, the private mortgage insurance, but that's not a big deal because once you're in the house, they make it pretty easy to get rid of the PMI within the first few years if market conditions go right, and then generally like around 7 years you can get rid of it. So it's in my opinion, it's not worth putting down the extra money just to not have PMI. So debt to income ratios, this is your total gross monthly income versus the debts that you have. So there's only certain debts that we count. When we pull your credit report, whatever shows on the credit report is what counts against you. So auto loans, disclaimer, that's the number one reason why people cannot get approved for a house, because they have $1,000 auto loan payment. That'll put you over 50% on that far right every time. So be aware of that. Any credit card payments, which are generally, credit card payments are pretty low, so you can have a few of those. You do need debts on your credit report to have a good credit score. So it's fine. We're not, doesn't hurt you too bad to have some trade lines and some payments. It's a little harder to get approved these days because housing costs are high. So two incomes is good. If you have two incomes, you'll probably be fine. If you only have one income, it's got to be a good income. So around, I would say 80,000 a year plus is what you need between either one or two borrowers. Just as a kind of a general idea where you need to be at in Utah. Okay, part 2, house hacking, the fun stuff. So we're going to talk about 3 different things: border income, ADUs, and mother-in-law suites, which are these days kind of pretty much the same thing. So we'll do the definitions and tell you kind of how they differentiate on that. They're trying to help people out, so they're making things easier, like the mother-in-law suites, to actually be able to help you qualify for the loan. And then multi-unit properties, that's 1 to 4. So duplex, triplex, and fourplex. If it's 4 units or less, you can use the same loan programs that we discussed in the first section for any of those. So VA, FHA, and all that, you can actually get up to 4 units. Okay, first, border income. This one, not very many people fall into this bucket, because the border income is where, let's say you just buy a normal house, there's no ADU, there's no separate units, it's just someone renting a room in your house. So there's a lot of restrictions on this. Mostly you want to have, when you're renting somewhere, you want to have a roommate with you while you're renting for the last 12 months. So we'll show FHA loan rules. Yeah, the border must have lived with you for 12 months. So like you could be in an apartment renting out a room, or someone else's basement, or even renting a single family home. If you have roommates living with you, you have to, they got to send you each month on time for 12 months. You have to be able to show where it's coming from. So that's the point of this class, because if you don't know this well in advance, you're never going to be able to use it. And then, yeah, they do have limits. Like, you can't game the system where you're just using rental income to buy a house. Like most of your income still got to come from your regular job. So 30% limit on what can come from rents. Conventional. So each loan program's a little bit different. So on conventional, it's got to be a family member. And then the rest of it pretty much the same there. And then, yeah, here's just a math example. If you're making $5,000 a month, you're renting out a room for $800 a month. Then when clicked back. Okay. Yeah. You add that rent to your income. So now you got $5,800 a month. Yeah, even a little bit of extra income can make a huge difference. I didn't do the math on that, but I don't know how accurate it is on today's rates, because interest rates are going to change all the maths. But just as a generalized example, like a little bit of income can add quite a bit of purchasing power to help you get approved. So ADUs and mother-in-law suites. So an ADU, that would be, traditionally the definition would be like a tiny home in your backyard, where it's just a second separate dwelling. It's it's going to be much smaller than your primary residence. So you could buy one on Amazon and put it in your backyard, but that part's easy. The tough part is you got to connect it to sewer and electric, so that it's going to be a process still, but they've expanded that definition to now you can see like a basement apartment, a garage conversion, or detached guest house. So on the left, what qualifies? So yeah, if it's your basement, it's got to have its own separate entrance. So it's got to have a walkout. So you see a lot of people buying houses, and then you can pay a contractor to dig a stairwell and a door, so they have their own exit. Or any house built on a hill, the backyard will have the exposed basement, walkout basement. That's ideal if you can find something like that. But it does, obviously it's got to have its own kitchen and bathroom. They can't be coming upstairs to use your stuff. So if you have a basement apartment and then the stairs connecting the upstairs and the downstairs, they require that you have kind of like a hotel room where both sides have doors that they can lock the other person out, so that the access is fully separated. They don't require that you like go in and sheetrock a wall or anything anymore. So that it's pretty reasonable to, there's a lot of houses that are already built like that. So you can find them. And yeah, when you're shopping for a home with your realtor, they'll be able to, if that's what you're looking for, they can just give you a search and only send you those homes that have qualifying ADUs. That's why I work with Brandon and Drew so much as realtors, because they've done this on their own homes. And so they know like all these little technical details, so that you don't necessarily have to memorize all this stuff, because they know what houses to show you that we can do the house hacking on. So because they are house hackers. So that makes it easy. Same as the border income. This is on the house you're buying. The reason why this is like we could use this much more easily is you don't have to have any history of renting to other people. You can just buy this house. You don't even need a tenant lined up for the basement or the ADU yet. We can do an appraisal. The appraisal will come out, get comparables of other houses with ADUs in your area that are being rented out, so they can collect that data of what the rent will likely be for you, and you can use that income without even having a renter yet. So they consider that there's going to be vacancies, between the tenants when they stop making payments, or their lease ends and you got to find a new one. So that's why they use 75% of the normal rent. So if you're renting out your basement for $2,000 a month, which I think is probably about average right now, then you'd get $1,500 added to your income when you come to apply for your loan with us. So that boosts your purchasing power a lot. On the far right, almost every loan program, or all of them possibly. I don't see VA on there, but FHA, conventional, USDA, which does require rental history. So that one's a little different. But that's our job. I know what the guidelines are, what programs to use for certain properties. So I'll sort that out for you. Okay, the last one, multi-unit. This has been around forever. This used to be the way you had to do it. But yeah, duplex, triplex, fourplex. You can see FHA, you can still do 3.5% down. and we could even do down payment assistance to cover that for you. So you could technically buy these multi-units with 0 down payment. On conventional, they do bump that up to 5%. They want a little bit more skin in the game for these. It's a riskier investment since you are relying on renters, which are, unreliable, to help you make your payment. So yeah, if you're going to do this, you might, the more units you get, the more cash flow. So yeah, if you get a 4-unit, you're renting out 3 units to other buyers to help you pay your rent. Keeps going forward. Hold on. It's going the wrong way. There you go. Okay. We're going back. Okay. Same thing as the ADUs. They do 70% because of vacancies. That gives you, obviously you're getting the real landlord experience because these are going to be, you're not going to know 3 family members, so you're going to be renting to strangers versus if you're doing a basement apartment, hopefully a friend or family you can put down there. So it's kind of like a little baby step. But the difference on this one, they do want reserves. So what reserves are is, let's say your total mortgage payments $3,000 a month. Every $3,000 you have in checking or savings would be 1 month of reserves. So it's basically like if you lost your job, how many months could you make your mortgage payment just with the amount that you have saved up? And that can include 401ks, retirement accounts, crypto. So it doesn't have to be like liquid money in your checking. So even if you're spending all your savings to buy the house, if you have a 401k, you'll still have some reserves. So VA loan, typically they want landlord experience before you buy one of these. It's a little more difficult, but yeah, if you're getting border income or done something like that that we can kind of show the experience, then it can be done. All right, part 3, even more exciting. So you already own your house. How do you get more? So first, you buy your first house. You can use 3% down conventional, 3.5 FHA. 2, you live there for 1 to 2 years, make the payments, rent out some rooms or the basement, as we explained. You just got to save up, another 5%. So you got a couple years to do that. So 5%, let's say on a 400K house. So you'd need about 20 grand to get into your next house. A lot of people will do like a HELOC, a home equity loan. So once you live there for a couple years, if home prices really go up, like they did for a few years after COVID, you can pull money out of your primary residence to get your down payment for the next one. I've done that myself. So that makes it even more realistic for you. So then when you buy your next house, the trick is you have to move out of your first house, move into the new one. So they count that as another primary residence, which gets you the 5% down. So that's the trick, because if you just buy a house and then you decide to start buying rentals and stay in your first house, then you need typically 20% down or more in most cases. There are some ways to do 15%, but it's few and far between, and then you're getting gouged. So yeah, this gets you 5%. So night and day. I mean, that's like 100,000 plus versus 20 grand. So this is the way, the average working American can build their portfolio. So yeah, your first house, you want a starter home, a condo or a townhouse, so that, and those, townhouses can make great rentals if they allow rentals, because if you move out of your condo or townhouse, then you have the HOA, cutting the grass, removing the snow. So it's a very low maintenance rental opportunity for you. And I believe we have more details here going on. So you can do that, multiple times. So yeah, you got to move into the new one, at least 12 months in the old house. If there is a specific reason why you need to move, like if you take a job out of state, or you have some more kids, and there's not like a bedroom for each child, things like that, you can move on. FHA, they don't want you to get a second one unless there's a really good reason. So an example of a reason why FHA would let you get a second house, let's say you bought a house by yourself and you got 3 kids, then you meet someone else that has their own 3 kids and you get married, then you just went from 3 to 6 kids. So they would be like, okay, you can have another FHA loan. So it's possible, but it's rare. Conventional, on the other hand, you can have up to 10 conventional loans on your personal credit. If you keep going after that, you can buy homes in an LLC, or you can refinance your old conventional loans off of your personal credit into an LLC. So that you're playing a whole different game at that point. So we're not going to cover that too much in this class. If you run into problems with 10 loans, then just give me a call. We'll work it out for you. There's some key differences on your old house. So this is where the house hacking comes back in. If you're moving out of your old house, then you can use rental income on that house to help you qualify for your second home. FHA doesn't allow that, but also you can see FHA doesn't want you doing this with them anyways. So they do want you to at least have a renter in place on the old house. You just get a lease agreement signed. Obviously, like, all your stuff is still in the old house, so they can't move in yet. So you do got to like time it with you moving out, then moving in. So usually just lease agreement saying, hey, we got somebody lined up is all that we're gonna need. And then 75% again. And then if you're moving out of a 4-plex to buy your next house, then you do actually already have renters in the old house. So okay, next, down payment assistance program. So this is kind of going back to you buying your very, very first home again. This is what we have to help you. If you do not have any money at all or very little, we can still get you into a house. So first, Utah only, but most states have their own similar programs. You have Utah Housing. That's a state-run program, so it is subsidized, which gets you a better deal than pretty much any other down payment assistance. So the first home loan, this is their best bucket. Like, there's tiers. Like, you want to get this one if you can. It's got the lowest interest rate. When I made the slides, it was 5.875. It may be back up to 6% again, but just to compare, if you were to do just a normal FHA loan, the rates are around 5.5%. So this gets you almost the same on the rate as a normal FHA loan. So it is pretty good. There's income limits, and it's by county. So depending on if you're Davis, Weber, Salt Lake, Wasatch. They're all going to be a little bit different, but their income limits are roughly around 100,000 plus 120,000. So it's not that difficult to, I mean, they want people to be able to use the program. They're not trying to make it so that it doesn't help people. So this one, you got to be first time buyer. They do want a better credit score, 660. So in the middle loan, this is just anybody that doesn't make it into that first group for any reason. You can do it on a second house. You can do it with lower credit. So the rate, you can see the rate's just a little bit higher. So it's not as attractive, but it's just, yeah, if they have more risk, then they want, it's risk reward. They want a little bit more money if they're taking on more risk. So here on the right, this is how they actually get you the money. Typically it's a loan. It's not a gift or a grant. But they do have one new one that just came out in the last 6 months or so, I believe, where you don't actually have to make any payments on the loan. The amount that you borrow does increase the longer you keep it, but it's only 3.5%, which in today's rates, like there's no such thing as a loan at 3.5% in any type of borrowing. And I think you can still make that in like a money market account, high interest if you had one. So yeah, unheard of, pretty good deal. You don't pay it back till you sell the house, refinance, which most likely you'll be refinancing. Or if you keep the loan for 30 years, once you pay off your first mortgage, then they'll want you to pay off a lump sum. So hopefully you don't really want to wait that long. But that one, all you can borrow is just the 3.5% for the down payment. Yeah, these are all FHA loans, 3.5% down. So it is a little bit limited. You still need to find your own money for closing costs or get the sellers to pay it. And then, the bottom one, this is the one they've always had. It's just a loan. It's a second mortgage. The rate's 1% above the first, so you're paying like 7% plus. Not super attractive. Monthly payments on that come out to be about $120 a month. So it's very affordable as far as the monthly payment goes. But the advantage on that one is on top of the down payment, you can borrow even more to cover your closing costs if you can't get the seller to cover all of it. Here's some more grants in Utah that you can use with the Utah housing, or you can use these on their own. So Utah housing, they'll give you up to 20 grand if you're buying a new build. It's just a number. There's 491 left as of a week ago, so it's probably less now. The most that the home price can be from the builder is $450,000. So that's the entire reason why they made this program, is to incentivize builders to build cheaper houses that are affordable. So now, when builders are doing their subdivisions and designing these communities, they're considering, hey, if we can make these under 450, which, I mean, that'd be townhouses, like all the townhouses that are going up everywhere would be kind of what these are used for mainly. Or, if you're up in Tremont or, outside of the Wasatch Front, they still may be able to build like just a regular house for 450 potentially. So that's to help them build houses that people can actually buy. But you're the one that gets the money. It just helps them sell their units. So that's their incentive, because they can market the 20 grand to buyers. So that one, there's no interest. So it's even better deal than the other ones. And then, yeah, basically when you refinance or sell the home, then you do have to pay it back eventually. So still not free money. Okay, the next one, this is actually just free money they'll give you. So it's a real grant. These are very hard to find. This one is just through the Salt Lake Board of Realtors. It's a drawing. They put your name. I've actually been there in person while they do it. They just put all the slips of names in a bucket and draw them out and read 3 names every other month. The next one's March 18th, which is coming up. We got to do it now if you want in on this drawing. You do have to be pre-qualified. So I got to pull your credit, do an application, and it has to work. Other than you don't, like if you're short money to buy a house, then I can still pre-qualify you based on you getting this grant. Yeah, you never pay it back. They just give it to you. So there you go. All right. Own in Ogden. This one's a pain in the butt for me and for Brandon and Drew, but we will do it for you if you want it. You can get 10 to 20 grand, 10,000 for anybody that's buying in the Ogden city limits. It's got to be $430,000 or less, which that's all over Ogden. You can buy a house in Ogden for $350 if you really want to. So very doable. Income limits are the tricky part, but it is, the bigger your family, the more money you can make. And they're going to want to know. So if you have like someone working in your house and they're not on the loan because their credit sucks and they can't be on the loan, they would still count their income for this. So they're going to count the household income. And then, you get more money if you work in Ogden as a teacher, city worker, police, firefighter. So, I mean, there's nobody on this now that would meet that, but I am recording it. So maybe later someone will need that info. Okay, we have a website right here. I can get it to you guys outside of this. I don't think you can copy and paste that through the webinar. But yeah, if you go online and just search for grants, it's going to pull up everything that's ever existed at any time in the history of the internet, going back to 1990. So you'll find all kinds of cool looking stuff that doesn't exist, or you're going to get these ad funnels where it's other mortgage companies just wanting you to apply for a loan with them. So this website is just a directory that actually shows you, because there's city programs for a bunch of different cities and counties. Like there's Murray, Taylorsville, downtown Salt Lake City. They all have similar programs to the Ogden one, but the Ogden one's the best by far. Okay, next steps if you are wanting to get going on this. First, you can pull your own credit. You don't even, if you're not ready to do an application, annualcreditreport.com. Soft pull doesn't do a hard inquiry. You can just see where you're at. I can do that for you. If you do an application, you can just fill out an application online at your house. We can do a soft pull too. We don't have to put an inquiry on your credit. And then, we can do everything: credit, debt to income, down payment. We can just show you where you're at. And even if you're not ready to buy yet, that can still be helpful, because let's say you want to buy in a year, we can take a look at it and see where you're short or how close you are. So you have a whole year to know exactly, we can tell you exactly what you need to do. We have a lot of people that they're like, I'm not looking for a year. So they wait a year and then we do their application, pull their credit, and we're like, well, you can't buy now because you did this 6 months ago. And they're like, well, I didn't know. Well, yeah, exactly. So yeah, get pre-approved well in advance. There's no downside except you got to spend 10, 15 minutes. That's the only thing that you have to lose from that. Yeah, you already know about all the programs here, but there are some more. And it's better for us to find those for you because yeah, when you go online searching for them, you're going to get all kinds of stuff that's not real, very misleading things. So the next step, once I get you pre-approved, then is the fun part. Then you can start working with a realtor like Brandon and Drew, and they can show you houses. And they, like I said, they're house hackers, so they understand what I need, what my requirements are on the loan, so they can show you only houses that will work with the house hacking strategy. So that's the presentation. I was the speaker hosted by Brandon and Drew. Obviously, you can use anybody you want for both your mortgage and your realtor, but the reason that we recommend working with us is because we have done these loans, closed these loans. We know how to do them, so it'll just make the process that much easier.